Hey everyone, and welcome to another edition of the weekly Swyftx Squawk. I'm Pav, lead market analyst here at Swyftx, and it's a great week to be talking markets. We've seen Bitcoin and even the likes of gold surge double digits, but it's been into a pretty big news week that's still ahead. We're here at the start of this week to give you an idea of what's to come and how that could potentially impacting the markets for the good or potentially maybe for worse. That's what we're here to discuss today. But firstly, we can't help but not check out the markets. We've seen a big rally across even altcoin markets to this date. We've seen a lot of volume compared to what we have been seeing in previous times, but many double-digit gains within the top 10 and 20 assets. The likes of XRP up 50% in the last 7 days, and even Ethereum up 32% in the last 7 days as well. So it has been a broad sector-based rally with some other new narratives starting to play out as well, like Zcash, which is up 62% with some recent news of an ETF filing there. Now, where we find ourselves structurally on a chart of Bitcoin is we still find ourselves at previous weekly highs. So we'll see if we can stammer through that level and the bulls can remain in charge. We've just got some moving averages here shaded on the chart. But again, this move from top to bottom so far has been about 27%. The magnitude of size of this move is one that we haven't seen since the foothills of the bull market back in 2023. So this is a very big and steep move. Now, again, like I mentioned, it was a bit of a cross-asset market move as well. We're seeing gold currently trading 13% up in the last 7 days as well. And a lot of this is potentially being pointed at the idea of the debasement trade being back against the US dollar. So the debasement idea being that the market may be expecting further currency weakness in the US economy. And that comes particularly after US Treasury Secretary Scott Bessent announced interventions in the long end of the bond market. Now, I know bond market's not exactly the most sexiest thing to talk about, but essentially it does really tee up the market's view, particularly on the long ends. We're talking 10, 20, 30-year bond yields. Very much encapsulates how the broader market is thinking about both growth and inflation in the US economy right now. So to see it pry up to those levels that we haven't seen since 2007, we did see an announcement that there would be up to $4 billion worth of buybacks permitted, with more buybacks potentially coming along the way. And we've seen since this recent announcement as well that there may be some more further actions happening and other tools used to keep the long end of the bond market blowing out. But one of the clear interventions that they have described is essentially swapping or refinancing their book for now. So one of the key things to understand is it isn't stimulatory in the way that everyone expects it to be at this stage. There's no new money being created, but there is money being moved away from the short end of the market into the long end. So we are reducing something known as duration risk. So essentially what you can see here is the US 2-year that has reportedly been selling down. Basically, we're now seeing the 30-year go the other way. So that is that intervention. And if we had to try and visualize what does it look like, they're selling treasuries on the short end of the market and using that to buy back some of your more illiquid longer end of the bond market as well. Because unlike other traditional markets, as bond markets buy and sell, it changes the interest rate, but not in the way that you'd think intuitively. When we see bond yields go down, it's a net result of bonds being bought. And we see the bond yields rise, it's actually because the underlying bonds are being sold off. So that kind of explains why we're seeing those 2-year treasuries yields going up and the 30-year going down. Now, honestly, the biggest way I'm thinking about this is not so much what could it mean for the market in the immediate and short term. It's more that we have seen the policymakers, or at least from the Treasury side of the fence, because there's two parts to the US dollar side right now. There's the Treasury and then there's the Federal Reserve as well, which we're going to talk about in a second. But we've seen the point at which the Treasury wants to start to intervene and lay down the law and provide some sort of support for the long end of the market, because it's maybe seeing some concerns there that if we do start to see volatility in that part of the market, it could start to transpire and transmit through other segments of the market as well. And one of the key things that everyone's pointing to is we've got US midterms coming towards the end of the year. So obviously it may seem obvious that they may be wanting to at least provide some stability in price across markets as we head into that period as well, not see wobbles in things like the credit market, which is where we've seen a great deal of money being spent in the AI rollout, and then also equities being at all-time highs as well. Maybe there's just some need to try and keep that steady as well. But what we do have coming up that is pretty important to note is we also have the next round of inflation data coming out. This one's PCE, so it's the inflation on the consumer. This is the one the Fed really likes to pay attention to. So we talked about those two people really to think about when we're trying to consider what's happening to the US dollar as a currency. Inflation is one of the key mandates of the Fed, which is an independent body appointed by Congress. And then we also have growth in the form of GDP data coming out as well. Probably the more important one to take away from this is inflation, because that is something that the new Fed chair, Kevin Warsh, has been very vocal about maintaining that 2% target. And more importantly, when we think about what is their agenda and their incentives, they have a dual mandate. So it's all about keeping inflation in check, but also ensuring that growth and employment remain steady. And that's where things get a bit interesting, because we have seen the employment market really start to slump and slide since about March this year, right? And that's potentially been a bit under the radar. So there were some notable revisions in these figures as well that came out at the end of last month that we covered 2 squawks ago. But what's really important here is we are seeing interventions in currency markets by the current administration's treasury. And now we have the independent body coming out, potentially going to have to deal with, number one, those interventions. And obviously they're going to get asked a lot of questions by the media on how they're going to essentially address their view on what's happening there. But then you also have this concern potentially in the labor market, where we are actually seeing less job growth. And again, if we do see a lackluster growth figure too, that could also potentially cause some concerns for policymakers as well. So that kind of sets up maybe this Goldilocks scenario. Goldilocks in the sense that we're seeing, again, that the 2 components of cash at the moment, the Treasury ready to take action to support the market. But then we could also see policymakers do the same if they feel like there are some wobbles in that growth element of the market, and if inflation can stay in check. It has been relatively coming down. We talked about it as well last month on the scorecard. A lot of the movements in inflation were actually driven by energy costs and transportation costs rising. And a lot of that can be attributed to the Strait of Hormuz being closed. And we have also seen those come down in recent time as well. So it's a really interesting time where I guess what I'm trying to understand is, are the 2 parties essentially going to see the same problem through a different lens and look to provide stimulus and support the market, potentially ease some of the burden? Or are they maybe going to be clashing and we actually see maybe some volatility because the 2 don't see quite eye to eye, and they see that maybe the intervention is a bit unnecessary? Because there is a lot of speculation that, was this intervention even needed? The market was humming along. As we said, equity markets are at all-time highs. And we've just seen the market further price in now the weakening of the dollar. And that could be that expression that we're seeing through commodity markets, and potentially to some degree as well, Bitcoin being an asset of scarcity as well. But look, really interesting times. I think next week is going to be a very big week to understand what direction this is all going. I'm sure there'll be some volatility as well, but we'll be here to cover it all for you. If you want some more play-by-play actions, I recommend you go following me on Twitter. I'm surely going to be keeping everyone up to date as best as I can there. So that's at @PavHundel if you want to go follow me there. But that's it for today, guys. We'll catch you again next week. Again, bond market's boring, but it's bloody important right now. So make sure you keep you abreast of all of this now.